Welcome to the Untitled REI Club. People are still coming in. We just went through announcements before I started the recording. And as we get a couple more people in, Stu, I guess we'll hand it over to you. All right. Go ahead, Stu.
Hey, thank you very much. I appreciate it. My name is Stu Kerber. I'm with Columbia Ag Investments. I'm out of the Pacific Northwest, Greater Seattle area. I'll talk a little bit more about what we do at the end of the slide deck. But I guess, Daniel, first of all, thank you. I appreciate the opportunity to present to you guys. Really, this is designed to be kind of an overview or primer into investing in agriculture. So, or I should say agricultural real estate specifically. We'll talk a little bit about different types of structures, different types of crops and ag land, how you can get involved in it, some of the risks, some of the returns, and I'll try and leave some time at the end for questions. I don't know that I'll use the whole hour here, but hopefully you guys will find this beneficial. So jumping into this, I guess, what is agricultural investing? And it's first, I would say that agriculture as a investment class is generally regarded as a alternative investment class. Oftentimes, at least in the institutional world, this falls under what they categorize as natural resources. A lot of times, this will include other things such as timber, minerals and oil, aquaculture, etc. And typically agriculture is referred to as a subset of that, but it's really in an alternative investment class. And I'll talk a little bit more as we go on as to why that is. And there's a number of ways to indirectly invest in agriculture. That can be done through investment in commodities, commodity futures, investment in related industries such as inputs, like buying shares in Monsanto, for example. But what we're going to be really talking about is investment in or ownership of agricultural farmland. The other thing is that this can or cannot include ownership of crops, and we'll talk a little bit about that. Generally in most cases, it's involves ownership of the agricultural land, and in some cases it involves ownership of the crop as well. So why invest in agriculture? Well, first of all, at the individual investor level, I would say that there is a need for alternative investments. Generally, portfolios, at least from what we find, have a fairly good concentration of equities and bonds. Often, then the next diversification is into commercial real estate, which your club is obviously all familiar with. And we have a number of categories within commercial real estate that you can get into. However, they still typically all fall under the umbrella of commercial real estate and are impacted both positively and negatively by the market in sync, where agriculture really falls outside of that. So going on in the next point, it provides for portfolio diversification. And through that, it has, depending on what you read, it typically is referred to as either having low or zero equity and bond correlation, and many times can be countercyclical. We see that when there's a flight to safety in alternative assets and in a few other situations. But generally, the value and appreciation of agricultural land does not move in step with equity and bond movements. It's really outside of that. Speaking from a real estate standpoint and a commercial real estate standpoint, this is often, agricultural land investments are often referred to as having a zero vacancy model. And I'll talk a little bit more about this. In some cases, it can be viewed kind of as a zero vacancy model, and in some cases, it can be viewed as a very low vacancy model, depending on the ownership structure. Some other reasons why to invest in agriculture, just for some of the same reasons that we talk about. Why does it make sense to invest in multifamily? Because at the end of the day, people need a place to live and a place to sleep. Office has been similar. People need a place to work. I think we're challenging that thought right now a little bit with the reliance on work at home with COVID, but office space isn't going to go away. My point with this is that people need to eat, and that global food demand is continuing to increase, and regardless of what our economy does over the next foreseeable period as a result of the current market dynamics, food is going to continue to be in demand and will be needed. We're also seeing it as increasing on a global basis, and a couple examples of this. So first off, the United States is a net exporter of food by quite a large margin, net exporter of really agricultural goods in general. And a good example of this is China and their reliance on importing food. So they have roughly 20% of the world's population, yet depending on what you read, between 7 to 8% of the world's arable land. And that figure the arable land figure is continuing to decrease as development of agricultural areas for new factories and production pursues or continues. And we're seeing that trend in a lot of places around the world. The United States has more Class A farmland than anywhere else in the world. So we're very fortunate from that standpoint, but we will continue to remain a net exporter of food. The last point I have on here is consumer awareness and purchasing, and that's basically that consumers are becoming more and more aware of what is in their food, where their food comes from. The rise of organic foods, for example, is a good example of that. And we're going to continue to see those trends, and as that continues, we'll see more demand even into some of the more specialty crops, as well as specialty varieties within more of our standardized crops. So from an investment standpoint, I want to kind of talk about, let's just give you some background. So there's really two categories of crops that we're going to be discussing, and they both have different investment strategies and both require different levels of capital and different cash cycles. The first of these is going to be row crops. These are your more common, this is more common for investment, not in the crop itself, but in the agricultural land that supports the crops. Part of this is because the majority of our cropland in the United States is for row crop. This is a lot of, if you think about through the Midwest, Corn Belt, but we have row crop land all over the U.S. We're down in the southeast. California has quite a bit. The Northwest does quite a bit as well. So it's all really kind of all over. Examples, I put a bunch on here: corn, soybeans, wheat, potatoes, onions, really anything that you think of where you plant a crop from seed and then you harvest that crop and then you're left with bare dirt again. That's really what falls into row crop. The second category is what we would call permanent crops, and these are higher value crops and typically result in higher values in the land. Really, these can be thought of as anything with a tree or a bush, where the plant sustains year to year and the crop is harvested off of that. So some examples on here: apples, which we deal with a lot in the Northwest, cherries, almonds, walnuts. A lot of the nuts are real popular down in California. We've seen a lot of growth in that market. Blueberries, wine grapes would be another one. Hops actually hops would fall under more row crop. And then citrus would be down in the southeast, quite a bit of their concentration in permanent crops. So as far as types of investing, I want to talk about three different models. Now, before I do this, there's these three models are really based on kind of the direct ownership of the land. We'll talk a little later on about other types of investment into real estate or some other direct and indirect opportunities. But for purposes of discussing these different models, we're really going to be discussing direct ownership, and whether that would be through an individual investor buying or a syndication or a couple of different scenarios, but a direct ownership. So I guess the first model that we'll talk about is the owner-tenant model. Where the investor buys the land and then leases it to a tenant farmer. The second would be a direct investment model where the investor would buy the land but also take ownership of the crop. Generally, this only occurs in permanent crops or permanent plantings. And then the third is a hybrid model of the two, which is where the investor leases the land and then develops or owns the permanent improvements, the plants, and then takes the commodity risk. That's less common, and we'll talk about that. So let's kind of dive into these here. The owner-tenant model is the most common. This has historically been the way that people have invested in agriculture. It's also the way that the majority of the funds in the agricultural REITs and even in a lot of the institutional portfolios are invested. And so talking through this, essentially the investor acquires the farm grounds. So the funds or the purchases of the underlying ground. They then work with generally some type of a farm manager to acquire tenants, and the tenant farmer then leases the ground for a crop season. That's typically a year. And then that investor or landowner in return receives a cash return based on the lease rate, and then they're also getting the long-term appreciation in the land. So an example of this would be a 4 to 5% lease rate, and that's essentially would be the cash return. And then you would have annual appreciation of, I'm going to say, 2 to 4%. And we'll talk some more about the annual appreciation figures because there's some important things I think that I would like you guys to be aware of. Just to make you more educated investors in the market as people talk about farmland appreciation. So this is really a fairly basic model, and it's considered we'll talk about the cash cycle, but a lot of times this is called a no vacancy model. I would call it a low vacancy model because there is still vacancy risk. But typically the vacancy risk is low, and the reason for that is because the rents are paid up front at the beginning of the year. The real risk comes if you do not get a tenant for the year. There's a window where generally tenants are shopping or trying to lease because they need to get their crops in the ground. If you get too far behind that, then it's too late for them to get crops in the ground. But that being said, it's the release rate, the annual release rate is, I think, 85% for within the first 3 years and 40% within at the 10-year window of tenants releasing the same property. So it's a real long tenure typically in your leases, in your lessees, even though they're based on annual leases. Going on to the next slide. So the direct investment model. This is, I would say, the second most utilized strategy for investing, and this is what we as our company focus on. And it's typically utilized in permanent crops. And like I mentioned earlier, this is really where the investor acquires the land as well as the crop improvements. Let's just use the example of apples. The investor would purchase the land as well as owning the apple trees and related infrastructure, such as trellis systems and irrigation for those improvements. The investor then takes on that commodity risk. So rather than getting a cash return from the lease, the return for the investor is based on the sale of the crop. So it's a different risk profile because you as the investor are taking on the commodity risk, but it has a significantly higher upside, especially in years where a specific commodity does extremely well. A lot of times that's based on a shortage of supply in other geographical markets. Then the demand spikes and prices spike. So we see, typically where we model and where we're seeing that is about an 8 to 12% return on the commodity side. And it does vary based on the commodity, so I'm going to use that kind of roughly. And then we're kind of looking at that same annual farmland appreciation rate. Again, there is more risk in it. You can protect some of the downside through crop insurance, so there is some fallback there. There is significantly more upside involved in it as well. The third model is what we call a hybrid model, and that it's really used more by large institutional investors when they don't have access to the land. So to give you an example, in the Pacific Northwest, within the tree fruit market of Central Washington, until the last 24 months, it was really a seller's market, and to say that there were very few transactions that even occurred because sellers were not selling land, developed land, I should say, with orchards already on them. So a lot of institutional investors were leasing land and developing the orchards themselves, and it's still a model that we see, but I would say it's less common. Again, so the investor leases the land and develops the property, and they're taking the commodity risk. So they get that commodity return with essentially a lower basis because they have no land in ownership. So their I guess cash on cash return is higher from that perspective. However, they do have to pay the land rent. I've got 3 to 4% here. I'd say 3 to 5%. Anyway, that's kind of that third structure. Again, I want you to be aware of it. However, it is a less common structure from an investment standpoint. So from a cash cycle standpoint, as we talked, the rents are paid up front. So in that first example of the tenant lease structure, the annual rents are paid up front for the year. There's typically little to no capex throughout the course of the year, and that's the annual return, cash return, and then obviously the long-term appreciation upon the sale of the asset. On the commodity side, it really varies, and it's dependent on the crop, but it typically is over the course of the year. So let's just use apples again. Apples, as most permanent crops, go into some type of storage. So if you think about it, potatoes go into storage, onions go into storage. It's a little funny when we think about it because all of our apples are harvested really, in August, September primarily, with shoulders on each end of that, and then go into storage for the year. So when we're buying apples in May, they were really picked last August or September. But where that commodity is where the investor owns the commodity, that is settled or paid out when the sale occurs through the sales desk. So when it is moved out of storage and essentially sold. So a little different in the cash cycles there. That third example would follow the commodity cycle, where it would be paid out as well as the crop sales. So switching gears a little bit here as far as, so how do you invest in agriculture? We talked about types of investment. Maybe I'm actually going to start at the bottom on the list. I should have ordered this a different way. So the closest to what we've been talking to, or the most direct way, would be through either direct investment or ownership, where a individual investor or a group of investors purchase the underlying asset directly and then contract to have it operated and collect the cash directly. The second closest would be a syndication, which essentially is the same thing. You just have a sponsor establishing it. There's then some other more interesting ways that have been developed. I don't want to encourage one way or another. I would just say that to do your due diligence, as some of them, like anything, can have higher than average management fees for managing the asset, or other fees, or things that essentially eat away the return. But crowdfunding, there's a number of companies that are essentially crowdfunding these purchases. So they'll get a property under contract and then pool or sell shares to typically non-accredited investors. Usually it's a fairly small bite size, somewhere in that $10,000 to $25,000 range, and it's a way to invest. There's a number of funds out there, and with that, I would put a lot of institutional funds have exposure to agriculture in some way or another. Some of them are very specific, where a fund may be entirely in agriculture, or it could be a component. And then the last piece is that there are a couple of REITs that are focused in agriculture specifically. Again, I would take a look at the expense side and make sure that it fits your appetite and model. But essentially, it's different ways to approach agriculture as an investment class. So let's talk a little bit about risks, because I would say that the risks in agriculture, investing in agriculture, are different than any other type of commercial real estate. And before I say this, one point that I wanted to go back to, because I missed it, was that my comment on the no vacancy model. So really, another way to think about it, if we're looking at it from a commercial real estate standpoint, is that the lessor tenant model or investor tenant model is really a low vacancy risk. The direct investment, where the investor owns the real estate and the crop, is, I would argue, is a no vacancy model, but it's really more of an owner. Think about it as owner-occupied real estate. So rather than the rental income from the real estate providing the return, it's the real estate supports the operation, which the operation then provides the return. So just a little bit different way of thinking about it that kind of ties into probably some more comfortable, or not more comfortable, more common themes within commercial real estate. So sorry for the quick digression. Let's go back to risks. So one of the risks, just from an investment standpoint, is that some models do rely on have a high reliance on farmland appreciation to hit their return thresholds or the returns that they're promising. And I'm going to talk a little bit more about this and why it's good to have a healthy skepticism when looking at at the appreciation side. Another risk is essentially commodity risk. So commodity prices move, and that can have an impact on the returns. Obviously, it has a lot of impact if you're taking the commodity risk, but it can have an impact long term on the cash rents and the appreciation, because the cash rents are really tied to the net farm income, and I'll get into this a little more, but so commodity risk exists. Depending on the crop, you can have high export reliance, and as we've been experiencing over the last year or so, we've got some new trade pacts that are going into place that are favorable, but we've had tariffs and trade wars that have negatively impacted our exports and hurt our agricultural sector, which again can affect returns. Another one, which is probably more important within the permanent crop space, is changing consumer preference. So a good example of this is pears. Pears for years and years were kind of considered the treasury bill of permanent crops. They always did okay. They never did poorly. They never did great. They just always did okay year after year. And we've seen this until really about the last 3-4 years, where we've seen all of a sudden a decline in consumer demand. And it's largely attributed to the fact that, the way it's communicated is that a lot of the millennial generation, and I don't know that's just millennial generation, but I would say younger generation, is not interested in buying fruit that they have to buy and then let sit on their table for a week until it's ripe and ready to eat. They're also not poaching pears and putting them in a pie. So although a lot of people still like pears, the consumer demand has decreased for that crop entirely, which has put downward pressure on returns. Farming risk is another one. As we all know, drought in California is a perfect example. That's really hurt their agriculture sector over the last 6-7 years. Weather, we've seen big swings in weather all over the nation, and that can have a big impact. There's a disease or potential insect potential, different things like that, depending on the crop, how it's grown, etc. And then the last risk is labor, and labor is in some cases the 800-pound giant in the room, or gorilla in the room. Our domestic agricultural labor workforce continues to decline, and it has been supplemented primarily through immigrant labor that is brought in under the H-2A program, which is the federal code designation for it. And it allows non-immigrant workers to come in, and they get paid very well. They get provided housing and transportation. It's quite expensive labor for the growers, for the farmers, but it's very high performing and consistent labor. We're going to be testing that right now through coronavirus, how big that labor risk is. Typically, the employees that are brought in live in group housing situations of between, say, 8 to 24 individuals in a kind of a building or facility, and they're living in close proximity, and then working in close proximity. And then related to that, the State Department has stopped issuing visas for immigrant workers to come into the U.S., with the exception that if they have been previously admitted under the program, they are allowed. Fortunately, the repeat in the program is very high. They estimate between 90 and 95%, but these are all new pressures on our labor force that we have not seen before. The flip side of that is that we are seeing a significant increase in automation at all levels and automation in all different crop types that will, for better or worse, decrease some of the dependence on labor and take out some of the labor risk associated with agriculture currently. Now, the flip side of that is returns. So I mentioned, I talked about this. Land returns are generally tied to agricultural prices. So the best way to think about that is land returns, or what you can charge for rent rates, are tied to net farm income. So as net farm income goes up, the ability to increase the rental rate goes up, which then results in an increase in the underlying land value. But this also creates an upward limit on appreciation of land, because without increases in net farm income, we're typically not increasing the rental rate. So there's kind of a generally cap without outside economics playing in, or outside, I shouldn't say economics, market dynamics playing in. And like I said, generally, so yeah, farmland values will rise and fall trailing, but with net farm income. Generally, I would say that 4 to 5% is pretty consistent for a cash return standpoint for direct ownership in the agricultural land. So I wanted to bring this up because I mentioned earlier that I wanted to talk about agricultural land appreciation. This is from the USDA, and it's average cropland value from 2005 to 2019. And it really shows what kind of how the cycle has worked. And what you'll see is that we talked somewhat about it being counter-cyclical and not moving with equities and bonds. As we were in the recessionary period, we saw very strong performance in agricultural land values, and then it's really flattened out since about 2014 on. We've seen a little bit of appreciation, but it's remained fairly flat. Now, I will say this is for average cropland value for the United States. If you break it into individual sectors or geographic sectors, some geographic sectors have performed extremely well. Pacific Northwest and California have done very well. Grain Belt has not done that well over the last 5 years, and the Southeast has had some downward pressure as well. So it really depends on where, what sector, but I think this is a good overall picture, and there's a reason for this. So I'm showing you here what the historical performance is, but what I want to talk about is why it doesn't matter. And when I say that, what I mean is let me go back real quick here. A lot of the investments will show sometimes aggressive appreciation, maybe 6-7% annually, and they'll show that, well, if you look at from 2005 to 2015, we had very strong appreciation of agricultural land. We did, but we had two unique things that occurred during that period. One was a recession. And what that caused was it caused a flight to safety, and so we saw values of internal alternative investments increasing. But the biggest driver of the value of the increase in value of underlying farmland was quantitative easing. If you think about it, quantitative easing occurred from 2007 to 2014. And if we look at where on the chart we see the greatest growth, it's during that period. And I'm going to go to the next slide, but it did that for a couple of reasons. So it caused a general increase in the liquidity in the markets, again, looking for returns and looking for safety. But the biggest thing it did was it devalued the US dollar. And when the US dollar gets devalued, typically our exports go up because if you're a country buying US exports, they became cheaper. Well, food became cheaper, and as a result, we saw an increase in agricultural exports, and that resulted in an increase in net farm income, which resulted in the ability to increase rental rates, which then resulted in the increase in underlying land values. So you can see it's kind of an interrelated cycle. And why I'm saying it doesn't matter is, and I will say that I wrote this a couple weeks ago, so I'll talk at the end kind of what this might look like going forward. But short of another event like what we had in 2007 to 2014, I think I would say that land values, agricultural land values, are more than likely going to kind of chug along at that 2 to 3% appreciation. So investment market going forward, like I said, 4 weeks ago, I would have said that we'd had 2 to 3% annual appreciation. We were seeing decreasing volatility in commodity prices. This is largely due to stabilization of the export markets as we get through some of the tariff and trade fears, and then signing into some of the new trade agreements and adoption of the trade agreements. And the other part is, I would say we would see continued institutional consolidation. I think that's going to continue no matter what. Agriculture is still an area that has yet to see, there's a lot of sectors that have yet to see much consolidation, and that is a trend that will continue. Today, I think we're at a unique time because all of a sudden we have a significant level of volatility in the equities market. The appetite for alternative investments is going to be increasing. The appetite for investments with underlying hard asset values is going to be increasing. The Fed involvement, I put this on here because there's implications for the US dollar. If we have a round of quantitative easing or a stimulus program that devalues the dollar, we could potentially see a increase again in net food exports and increase in net farm income that results in values increasing at a rate above that kind of stabilized annual appreciation. That I would say is just, I don't have a glass ball, so I don't know, but that is a possibility that I don't think was on the table 2 months ago. Near term, we could see some possible supply chain issues or export issues. We're seeing some stress in good stress, but some markets, for example, potatoes and onions cannot keep up with production right now. They can't get enough drivers to get the crop to the store rather than taking it to the shed like they typically would for storage. This is largely, a short-term issue as we work through the, I guess we might just say, hoarding of food supplies in the U.S. Largely speaking, our agricultural and our food distribution systems are doing very, very well and remain unchallenged. But we may have some supply chain issues in the future. I would say the biggest issue there is likely going to be labor, especially for crops that have that are labor intensive. Permanent crops typically require more labor because a lot of times they require application of chemicals and pruning throughout the year rather than just at harvest. I think we're going to see a slowing of transactions within the agriculture sector in 2020. We had seen a general increase in year to year, both in net number of transactions as well as volume. And I think we're going to see some slowing with that, just as along with everything else. And then I like I said earlier, I think we'll see potentially a flight to safety as people look for alternative investments within the market to place money, both from looking for some level of return as well as just somewhere so that they feel safer to park money. Real quick, just a little bit about us. My partner Jay Graham and I started Columbia Ag Group in 2007. We primarily worked with or have worked with institutional investors in the Pacific Northwest within permanent crops. Specifically, we work in Oregon, Washington, and Idaho, with offices in Idaho and in Washington. We've closed a little over $250 million in direct investment in agricultural real estate, and the returns so far have been, depending on the project, in the 12 to 18%. So performance has been really well. Essentially, we started Columbia Ag Investments last fall, recognizing that there was really a lack of what we felt was a platform for investors, individual investors, to access the same asset class directly rather than going through a fund or other mechanism. So we're focusing both on direct investment for individual investors as well as working on some syndication opportunities. So that's my little plug and a little bit about us. You can here's a slide. This is I'm in the middle. Jay is over behind me to, well, I guess left on the screen, my right shoulder. He's my partner on the acquisition side, and then some of our other farm managers, as well as our CFO on the far right of the screen. So my contact information's on here. Feel free to reach out. There's more information on us on our website, and that pretty much wraps up my presentation. I'm more than happy to take any questions in the time that we've got remaining.
Hey, Stu, appreciate your time. And if I missed this in the beginning, I apologize for asking, but as far as the, are these long-term lease agreements that you have, or are they year to year, or how does that typically work? And then the other question would be, I don't know, I picture farmland and I picture someone actually living on the land itself as far as managing and everything. You guys have to provide housing and all that good stuff. And
yeah, both good questions. So yeah, terms of the leases, and the owner tenant model, they're typically 1-year leases. So it's the best way to think about it is kind of like growing season to growing season. So they typically get, most of those for row crops get negotiated over December, January, and usually kind of signed into place around then, and they'll go through, October, November. But essentially they're leasing it for that growing year, for that 1 year. It's not real common you see multi-year. I mean, they can be negotiated, and in some cases they exist, but the majority of leases are from year to year. With regard to somebody living on the land, it really depends. A lot of times, so in almost all cases, especially if you have permanent crops or ownership in permanent crops, there's a farm manager that gets contracted, and really, I mean, the way to think about it, it's a property manager for any other commercial real estate asset class. So they're within, if you own, say, let's within the owner tenant model, they're probably just negotiating the leases and making finding a tenant and making sure that there's a tenant is in place. It's a pretty not a real big involvement there. Maybe some monitoring over the course of the year. On the permanent crop side, where there's ownership of the crop, then the the farm manager really is more specialized because they're actually farming the crop in that case, rather than the tenant farmer. So they need to have the expertise to farm because their performance is your financial performance. But typically those contracts are written in a way that there is some performance incentive for them to maximize return. Does that make sense?
It does. Appreciate it.
Yep.
And are you able to share your the presentation? I don't know if that's a question for Daniel or.
Yeah, I'm happy to. Daniel, I'll send you a new copy of the one. I made a couple little just tweaks to it, but I'll send a copy to Daniel and he can get it distributed out to you guys.
Cool. Thank you.
Hey, Stu. So, I've always felt like land investment is a great investment since they don't make more of it, right? But I also feel that the average investor in real estate invests in real estate for two main things: predictable cash flow and depreciation benefits, right? And you can't really depreciate land. Can you maybe touch a little bit on, what are some of the depreciation and other benefits that an investor would get in farmland aside from, the various returns that you cover based on the different leases that you can have?
Yeah, so the depreciation standpoint, you're right. You can't with land ownership, you're not getting the depreciation. There is the ability to depreciate the crop, the trees and infrastructure on the permanent crop side. And the schedules for that vary. I'm not going to get them right if I go off the top of my head. But there can be some depreciation benefits there. Again, though, it's that's not the primary purpose. I mean, really, I guess what I would say is the majority, or the reason that I would say investors invest in agricultural land as an asset class is it's a diversification play. So yes, you're getting, you're going to get cash return. You're going to long-term get appreciation. It's not going to be the biggest piece of your portfolio. It's going to be a part of your portfolio. It's going to, again, it's going to play that diversification. It's going to be something to help support your portfolio in the cases of economic downturn. But the benefits are gonna look different than they are, a typical commercial real estate where the majority of your value is in the improvements rather than land.
Got it. Okay, that makes sense. Thank you.
Yep. Well, if there's no other questions, I'll turn it over to Daniel. If you guys have any questions that come up after the fact or anything that you want to reach out, feel free.
I have a question actually here.
Yeah, go ahead.
So what is the minimum investment you're looking at? And you talked about the three different investments, right? So what kind of commitment are you looking at for those three investments?
So that I would say that depends on the structure and the model. So we've got the three different kind of types of investment, but really it's going to vary. So for example, if you're looking at investing in a lease tenant model, but doing it through one of the, what I would call kind of crowdfunding platforms, they sell shares and they're going to be, in an individual asset anywhere from $10,000 to, $25,000 a share. If you're looking at the REITs, you can buy shares directly in the REITs of, just like any other REIT, whatever the share price is. If, from a syndication standpoint, like what we're working on our first offering here right now. It's likely going to be about a $5 million roughly acquisition price. And we're still talking about where that threshold is going to be. I don't know off the top of my head. Probably somewhere in that $100,000 range. And that would be direct investment. To give you guys an idea, just maybe another way to answer the question is the value of cropland varies quite a bit. So example being that, row crop land, a lot of times I'd say right now the average, depending on where you are, is going to be somewhere in that $3,000 to $7,000 an acre range. If you're talking permanent cropland, the underlying land itself in the Northwest is going to be somewhere in that $15,000 to $18,000 an acre. But with the crop, let's take apples and cherries, with the crop already in production and well established, that value, the total acquisition price per acre is going to be somewhere in that, depending on the variety, anywhere from 25 up to, I'd say 20,000 up to 65, 70,000 an acre. So that you basically got a crop value of anywhere from 5,000 to to $50,000 an acre.
Okay, thank you.
Yep.
Hey, Stu, one
Hi.
more question.
Yeah.
If you don't mind. Can you talk maybe a little bit about the consolidation that is happening in the farmland and how, a lot of the land is changing hands pretty rapidly due to a lot of the farmers aging out?
Yeah, no, thank you. This is something I should have brought this up. So one of the challenges that we're finding as an industry right now, the average age of a farmer right now is 58 in the United States, and so it's a older demographic, and if we look back historically, the way that farming has worked is that typically, the farm stayed the same size or it grew, and the operation, when, dad and mom wanted to retire, it was handed down to the kids, or at least one kid who had an interest in keeping the operation going. Where we're at kind of a unique spot is that for the first time as a generation, what we're seeing is that the children who are in their, when I say children of the parents who are the farmers, who are in their anywhere from mid-20s to 40 years old, are the first generation that went off to college, went not just to the local university, but maybe to a university somewhere else, and then got a job, and are a lot of times living in a city. Maybe they grew up in Eastern Oregon on a farm, moved, went to University of Oregon, and now they're working at Intel, and they don't want to go back and run the farm. And we haven't seen that before. And so what's happened is that natural exit or retirement strategy doesn't exist like it used to. And also the cost of or the value of agriculture and the land has continued to increase to a point where the neighbor can't just buy the neighbor like what used to happen as kind of the alternative to passing it to the kids. So it's created this opportunity for institutional investment. I'm going to use institutional investment because that's where we see the majority of the consolidation, but to come in and to invest within the market or within specific agriculture types and essentially consolidate what we've seen as historical family farms into larger operations, with the idea that they're going to bring efficiencies like with any consolidation. We're going to probably see that continue. We saw that start really 15 years ago in the Midwest. We're quite a bit behind in the Northwest, somewhat behind in California. Southeast, we've seen quite a bit of consolidation in the Southeast. I mean, to give you an example, there's one investment fund that owns 60% of all Georgia peaches. So it's there can be some pretty strong concentrations. Now that doesn't necessarily mean that there aren't opportunities outside of that, because there absolutely are. I mean, it creates some unique opportunities through the consolidation, but it is a market effect that we're experiencing and will continue to experience, I think, for the at least the near future.
Okay, Stu, I think we are out of time now. Thank you so much for coming and sharing with us.
Hey, thank you very much for the opportunity.
Yep. And for everybody who is on the line right now, make sure if you've enjoyed this that you leave feedback in the forums and also to Stu personally. And if you would, I would really appreciate if you would forward this meeting opportunity on to other people. We're going to have some great speakers coming in next week and the week after that. And I'd love to see a full house. Okay, everyone. Have a healthy week.